Welcome to Power Charting. I'm your host, Bruce Fraser, and welcome, White Coffeeans. Thank you so much for being here. I always appreciate it when you uh, watch and also give me this invaluable feedback on things that you're interested in and would like me to cover and talk about. We're going to continue our Wyckoff Speaks series in the weeks ahead. But I felt today that it was important that we do a stock market update and review some important considerations here as we enter the new quarter, the new fourth quarter. Very important time. We are in the month of October. That has consequences for a number of different reasons, and we will cover a few of them today. And we have a subtitle for this talk: is the stock market trend in peril? And with that in mind, when the trend begins to bend, it is no longer your friend. And we are going to uncover some long-term trend charts, which I think are at an incredible juncture at this time. Very important to look at. We've looked at them before at other important junctures, which we will review, but we are going to check the status of the long-term secular trend of the market from these great trend charts. And then we're going to get more granular and go into some stock index studies and update them with some point and figure work. So here, very important announcement. This is going to be a great, good time that Roman Bogomazov and I are going to conduct an open session of the Wyckoff market discussions. And we are it's like 700 episodes of this series. It's hugely popular. And we, on occasion, open them up for all of our Wycoffian friends to come attend. And we would love it if you were there October 11, 3 p.m. Pacific time. Go to wyckoffanalytics.com to register. Absolutely no obligations, totally free. We just have a great time, and we just go through so many different aspects of the markets, and we cover really all of the important markets. Not that there aren't some that we can't get to, but we try to be somewhat all-encompassing in our discussion, and we think you're just going to have a blast. It's going to be a really good time, and we want you to be there. So October 11th, and we'll see you then. So moving on to our first trend chart, and there's going to be about 5 of them. I believe it's 5, but anyway, you have seen these charts before in the past, and we are going to update them because they're at such an interesting juncture at this time. Dow Jones Industrial Average. This is a trend channel, and really a trend that began in 2009 at the end of the bear market that was just the 07, 08 bear market, terrible bear market. And it was, a phenomenal upward stride of this market, which you can see. And we capture the essence of this with let's see if I have my little marker here, with these trend channels. This is log scaling across here. And what we do is in Wyckoff is 2 adjacent peaks or troughs. This is reverse use of trend lines right here, which means that we start with the primary trend line over the top of the market. What we are attempting to identify with this trend analysis, it's remarkable how well it works. And it's done differently than any other trend line approach that I've ever seen. It's unique to Wyckoff. And look at what happens. We want to capture the essence of the stride of the trend, up or down. And here you can see these 2 points become the stride of this market, the second one in 2013, and become the stride with overbought conditions here and here. And we take the intervening low and we draw the parallel. That's the reason I use a dotted line, to demonstrate that that is the parallel. That is not the primary trend line, and that produces our channel. And so you see here, oversold in 2016, oversold in 2020, almost oversold in 2018. And then we picked up this chart at the end of 2021 when it became overbought over the top of the channel. And we said this is an overbought condition for this bull run, and that if it pulls back into the channel and doesn't keep accelerating, it could very well fall right back to the bottom of the channel and do it in short order. Exactly what happened at that time. We then reconsidered these charts with the low that was put in at the bottom of the channel, oversold condition, and then so we did get a rally there. I thought it was a very important, markets on the edge. I talked about these charts in power charting at the time and said that these markets are on the edge. They need to rally and get back up into their channels. You'll see more on this in a minute. But look at the nature of the rally in the Dow Jones Industrials that occurred thereafter. That rally did not get back up to the overarching supply line. It did not have a normal rally back up to the top. Now, it's possible it could still do that. And let's hope for that, because it has pulled back here as of the early part of October, and these are monthly bars. It's pulled back to the oversold line, and it is teetering on the decline through and out of the upward secular channel of this bull market that goes all the way back to 2009. This is a perilous moment in this market, and we are going to watch it very closely to see whether or not these indexes can hold at this level. And I have more to show you, but here we are at this time, and we are resting on that level. And let's move on and look at some other examples. The little different approach here, I'm looking at the S&P 500, same time period, secular advance from the 2009 low right here. And you can see this big bear market, and look, got up to the top of the Keltner channel, became overbought over this trend line, a little hard to see, but that trend line became overbought, touched the Keltner, the upper edge of the Keltner, and then started its descent, and it was a significant descent, rode along the bottom of the Keltner channel throughout the late stages of the bear in 2008, 2009. Very nasty period in the market. More to say on that in a minute. But you can see, again, reverse use of trend lines. We use this peak, that peak adjacent to each other, and it set the stride for the advance of the S&P throughout that whole period. Became overbought. The first time we actually looked at this chart, it had become overbought here in late 2021 at the top of the bull market, over the top of our long-term trend channel. Let me actually blow this up for you so that you can see this quite closely. And so became overbought over the top of this trend channel and the Keltner line, which is a very wide channel in its own right. And then we said at the time with this chart, we showed this when we showed the Dow chart, that a decline back into the channel could result in a very swift decline back to the bottom of the channel. Well, that was the bear market of 2022, and it became oversold at the bottom of the channel. It became further oversold at the October low a year ago, below the channel, and then rallied. But look at the difference between this and what we just saw with the Dow, is that we have a decline here that goes below the channel, and we've had an epic advance. We've had a phenomenal 1 year long advance from the October 22 lows to the July 23 peak. Here we are in October now, a year later. The best that this rally could do was to rally back up to the oversold line, the lower line of the channel, and it is now fallen back decisively back below the area of the channel. This is again, the market on the edge, because if we lose this secular uptrend, then what does that portend for the potential for the future? Do we have a normal recession? Do we have a normal bear market? Is there something longer term? It's too early to tell. But the need of this market to be, and this is in a conversation where I want you to keep in mind that the Federal Reserve has been very tight in these the prior almost 2 years now. And so we have a tight money environment out there. This whole secular bull was made with an easy money environment by the Fed. And we have the opposite today. And we are losing our upward stride. So this is the background context of the situation that we find ourselves in. All right, I got to keep going here. I'm moving too slow. I just want to point out that this is the bottom of the Keltner channel down here. So this is potentially historically the levels that it could achieve in the bear market of 09. It turned the Keltner down and they both rode down together for a period of time. Not predicting that, just pointing out that that is a possibility if we stay below our upward stride of our secular uptrend. Okay, so this is very important. We are about to turn negative on the signal line on the MACD. That's something to keep an eye on. And then more on this, how I construct a rate of change. This is 3 months, and it became somewhat overbought in 2023. Did not achieve the upward area. How I get overbought and oversold is very different from most other people, and we will talk about that in a later session. I've got more trend to show you because the trend is so important to us. Here's the epically most stellar trend of the bull market, and also the most epically dynamic upward trend since 2022. And notice over here where this red arrow is, and I'll talk a little bit about the put call ratio at the bottom, but we became oversold here. We had extreme pessimism in the put call, but we rode along that oversold level, did not really break it down. We flirted with it as we had in prior periods. And these Nasdaq 100 stocks, the Magnificent Seven, and so on, have really been the dynamic movers of this whole bull market, going all the way back to 2009, 10. This is traditional use of trend lines, by the way. Normal drawing, look at two adjacent lows, intervening high. Look at how this upward channel is being contained in its advance by this beautiful structure of this channel, which was constructed off lows in 2010 and 2011 with a high in early 2011. That's amazing. Wyckoff contended that the stride of a bull market will be set very early in its bull market. And that is exactly what this chart demonstrates. Now, moving on. This was the best rally. Again, markets on the edge right here in late 22 at the bear market lows starting in October, and then higher lows in December. That was a very important low. That was a test of the October low, and then a rally. Look at how this rally got almost to the top of the channel. This is clearly the place where the action has been in this year-long run in the stock market starting in 2022. And footnote, and that is that this rally was not enough to get it up to the overbought line before it started to turn down. Could it yet do that? Absolutely, it could do that. Let's hope that it does. But we have to look at this in the clear light of day. And note that this rally got up almost to the bull market highs of 21. And this looks at this time like it could be a secondary test of that climactic high. Look at this huge throwover event that took place with huge call activity in the put call data. And now we've had pessimism that came in at this point here, extreme bullishness here, market turned off of this extreme bullishness, and now we're getting back towards the level where pessimism is starting to come back into the market. Could be bullish. This is an environmental indicator. It's not a perfect timing tool, but it does help us to understand how people, speculators, are looking at the markets. We will look at this indicator more in the weeks ahead. Now, here's the granddaddy of trends. This one is really interesting. And this is a chart we've looked at in the past. This is the New York Stock Exchange Composite, $ NYA, if you're using StockCharts to draw it. And the traditional use of trend lines, 74 low, 82 low set the anchor points. They're adjacent. Intervening high sets the overbought line. We did a second overbought line on this high here. This was quite beautiful. Overbought up here, bull market peak. This was 2001, 2002. So, I mean, this is a trend line that goes back, a channel that goes back 50 years. And so we can see here there's a number of bull and bear markets that have occurred throughout this whole period. Here's the 2021 peak, and then a decline and becoming oversold slightly through the demand line in 2009, in 2020, 2022. But look what we have now. Very important. Let's blow this up. And we can see here that this rally phase in the New York Composite off the 22 October lows only could get up to the demand line from underneath. That's a position of vulnerability. And so this market is just riding along the demand line underneath, which now is acting as resistance. So very, very important event. We need this to get back up into the channel, in my estimation, to be able to continue this secular trend. Otherwise, is this a climactic surge here, this rally phase in the COVID era, and then a secondary test, and we're going to get a decline out of a 50-year secular uptrend? I can hear you saying to me, let's keep an eye on this one and watch it closely. And then finally, this is a chart I showed you the last time we met on power charting. This is September. Oh no, I brought it up to date October 4th, but I think around the third week of September is when we looked at this. And so this is just the China fund, and you can see here that it's actually sinking further below this lower trend channel line. And so we'll watch this closely, because this is also a very important upward stride. The 2003-2005 period sets the stride, reverse use of trend lines, upward channel, and it's flirting with the bottom of it. And much weaker market. Look at the relative strength than our domestic S&P 500 market. So the relative strength here is saying that this continues to be a laggard performer in world markets. Okay, let's move on. Let's become a little more granular. I'm running out of time. I apologize for that. The chart on the left here is the New York Stock Exchange stocks above their 200-day. This indicator, we've been using this for years and years and years, and we've been talking about it here in power charting for however many years we've been meeting. And this chart, this indicator is very important to me. It's a breadth indicator, but it also is a trend indicator. And so really think about and grasp the idea of this. This is the number of stocks, a percentage of stocks that are above their 200-day moving average. When you have a high plurality of stocks above their 200-day, that is a solid definition of an uptrend. And so I look at these stocks, I'm always looking at their location to their 200-day individually and as a group. Now, I have more to say about this in a minute, because I think that there's some implications of this indicator. And note how since July, it's in a southward direction. And you recall from our prior discussions that I look at divergent characteristics at the highs and the lows, and I also look for overbought, oversold, and directionality. So if I get an oversold, this is down below 20%. Then 20% of all New York stocks are above their 200-day. That's a very low number. Very few stocks. The market can't go up. The indexes can't go up when you have so few stocks carrying the way. More on that in a minute. But here, upward stride. This is October, November low of 22. And you'll recall that we were becoming pretty bullish on the market because we were oversold, huge pessimism, and we were getting upward stride in our breadth indicators. This being among the most important. And so this upward stride really gave us a good signal. Get busy in the market. There are things to do here. And so here you can see this is October. This is stocks above the 50-day, a little more sensitive. This got below 10% in September of 22. Divergent characteristics. I've talked about this endlessly, and you probably get tired of me talking about it. But look, divergence, internal improvement developing in the stocks above the 50. They have to turn up before stocks can get above their 200. So this indicator is going to be more sensitive, and it's going to be earlier. So oversold, upward stride, beautiful time to start campaigning stocks and looking for the best of the best in the stock market. And we had a beautiful advance into the end of the year, and then another good higher low in December, another rally, and then we can see here oversold, divergent characteristics, upward stride. These are all just great trading periods. And so now moving on, here is the Nasdaq stocks above their 200-day with the NDX index, Nasdaq 100 below. This one over here is the Nasdaq comp, just to give you two different looks. But note, this is the 22 period. Here's the June low. Here's the October low on the 200-day. Beautiful divergence. Higher low in the stocks above the 200, lower low in the index. That means there's stocks that are improving, getting better. We want to find those and start to participate in them with good risk management, upward stride, divergent characteristics, et cetera, et cetera. This is at like 15% right here. And so that's how few stocks were in uptrends in the Nasdaq comp. Now you see here are stocks above the 50, same story. May, June, beautiful divergent low. September, October, beautiful divergent low. Beautiful higher low at the end of the year. Look, almost touched the lows in December, back to January. Institutions were throwing the baby out with the bathwater. Beautiful uptrend in the market. This was really, really a good speculative swing trading market. Now, look what happened from this peak. This is a high internal breadth peak in the Nasdaq Composite. Here is another peak, a lower peak, but much higher index value. So same with the NDX. That means that fewer and fewer stocks are lifting the market up in the Nasdaq, and these are the Nasdaq stocks. It's the stocks above the 50, but these are the Magnificent Seven and the other really high speculative growth names that were very large cap that were carrying the day. And so note that this rally here on the stocks above the 200 only gets to 47%. Only half of the Nasdaq Composite stocks are above their 200-day moving average. That is not a strong breadth move. I think that has to do with the Fed being so tight. When you're in a big secular advance in the market and you have a really good dynamic bull market going, stocks above their 200-day can be in the 70, 80, even 90% range. Incredible breadth. Don't have that here, which tells us that this rally, though good, worth campaigning, is nowhere near bull market quality, let's say. Well, over here in the 50, look, we are more sensitive. We get up into the 60+% range at this high, but look at how this flattens out with higher highs in the index, and this sets up the condition for a decline. So overbought, southward direction, market follows and goes lower. Okay, now to give you more information, this is a very important, and I'm going to go a little over today, so I apologize for that, but I know that you're loving this information. So because you're a white coffeean, and white coffeeans love this stuff, and so here, this is the flashpoint for me in this indicator. I notice that there's a lot of analysts that are starting to look at this as a breadth indicator and starting to pay attention to it. But there's a lot of nuance. There's a lot of things we can do with this that are, I think, very subtle, let's say. Well, here, this is the thing I want you to keep in mind. Where is the point when you're in a decline, when you have so many stocks below their 200-day that they no longer, the leadership can no longer hold up the index? And it's not 50%. It's more like 35% in my experience. So note that this yellow box is when the stocks get below their 35% level. And look at what the market tends to do. It becomes very volatile and starts to really fall. And my little alarm clock just went off. And so it starts to really fall. Here you can see this in 2018, 2020. You can see that once it gets below 35, the indexes can't hold up anymore. The big cap leadership names no longer have the umph, the muscle to hold up the whole index any longer. Here you can see in 2021, look at how long. Early 21 was the peak in this indicator at 80%. There's the top of the bull right there, 80%. Down, southward direction, down it goes, but it was all the way to 35% when the final bull market peak was brought in. Look at the deterioration underneath the surface in these Nasdaq comp stocks, and the Nasdaq comp finally makes its high because of the magnificent large cap stocks. And then once you get below 35, it's downward she goes, and you have tremendous downward volatility. Well, look where we are now. We only rallied up to 45, 46% at the top of this rally phase in 2023 into July. And now we're back below 35 in a downward trend, and we're starting to have a downward trend in the index. Very tricky time, I contend. And so something for you to think about relative to the markets. All right, so here's the NASDAQ. Here again is the stocks above the 50-day moving average on the NASDAQ 100. Note the little rally right here, but also look at what happened in the NASDAQ comp that had very, very poor participation as this market was attempting to rally off of this trend line right here. Let's see if I can get my little pen to work. So this rally here, and then look what happened. It first touch of the upward channel, which has been in place for all of 23, it was able to rally, very poor rally. We see that here in this internal breadth data. And then once it finally gets below this demand trend line, it starts to fall in earnest. Now I want you to, let me clean this up, because I want you then to see what subsequently happened. And oh, this is up to date. Okay, so we had this break, and so this puts us up through Wednesday the 4th. And so just keep that in mind. And we are now out of the upward channel, and I suspect that this support area, it may be where it has to go, but we can ask point and figure analysis for analysis about where it can go. So I drew 2 trend lines on here I want you to look at. Here's a channel drawn on the point and figure. This is 1 box reversal, 2-point scale. I'm using the triple Qs as a surrogate for the NASDAQ 100. And you can see that this is the stride, and that takes us down to 354. I drew this chart on September 20th. This takes us down to 354, and I want you to keep this in mind. Also, the steeper trend line, look at how it flirted with it, and it finally broke down out of it here. Now, we have a count 328, 318. Keep this picture in mind, and I'm going to update it to the present. Now, look what happened. Now, it's a little less data. This is just more beautiful distribution structure, sign of weakness here. October 5th, this is into today. Look at the hinge. So we have a hinge here. Let's draw that right there. And so this often is considered to be ice. Ice is a pause, no lift, no demand in the market, and it often results in a continuation downward. So here we are, and these are the counts that we just showed you on the prior chart: 328, 318, here and here, and so we are. And also, the other thing I would point out is here's important support. It is no longer holding. Often ice forms at support, no lift, and inevitably supply overtakes it and it turns down and goes to the count objectives. Here, I just want to make one last point, and then I'm going to be done, is that this is the quarter end effect. And I don't really know of anybody that really follows the quarter end effect. I've been doing it for, gosh, 40 years. And I think I've taken the quarter end, I've looked at the quarter ends going back into the 1800s. And I believe that the institutions dominate these markets. They drive the trends. And so I wanted, this is a chart I showed you on September 21st when I was pounding the table. We're at the end of the quarter, end of the quarter, end of the quarter. And we're in the end of the third quarter when we can get tremendous volatility. So this chart is through September 21st. I want you to sear this chart image into your mind right here where this this distributional area is, and also the support zone. And keep in mind that quarter end effect, here we are at the beginning of the fourth quarter, and we know October can be volatile in its own right, but quarter ends can be volatile in any quarter of the year. And so I've got these quarters marked off on this chart. And and here's the channel, and I'm going to bring it up to date. And there is where we are now. We've declined to the demand trend line. This is where we are as of October 4th, a little bit weak today so far, but holding on that trend line. Trend line could hold and rally. I'm going to show you a point figure chart in a minute to close out the session, but you can see the distribution. We've counted that. We're back down to the bottom of this upward stride. Be great if we could hold it and go up, and we would need to see cause build, and we would need to see positive divergence and trend from the internal breadth indicators to support that condition. Right now, we just have a market that's in free fall, and it's that old saying about don't try to catch a falling knife, because this is what it appears to be. And so with this in mind, quarter end effect, October, crazy things can happen. Also, we have the majority of stocks in the New York below the 200-day moving average. It's down below 35%. That's when the volatility can really come in on the downside. S&P 500 point figure chart, one box reversal, 20-point scale. We take that count, takes us 4120 to 4,000. This is a chart I published, showed it in our last get together on September 21st is when I made this chart. Keep this in mind. I'm going to update it for you now. And there we are. We're below the support level now, and right here. And you can see that we are consolidating at this level, but we have to go down to here to get to that 4,000 level, and or 4120. And so we still have room to move down, and that also is an area where there's support, prior support. And so with that in mind, I have one more to show you, and this is just the Russell 2000. And the Russell 2000, this is just a point and figure chart that I did on October 3rd, 2 days ago. And you can see there's a beautiful little swing count, and we are down into the zone where we are about to fulfill that count objective somewhere between around 170 and 164, which is support zone. Look at this beautiful swing count that we had up from this level, the smaller count fulfilled. It's in a giant trading range, and I encourage you to go look at the bigger picture of the Russell. I'm not predicting the Russell is ready to go anywhere. As a matter of fact, this is a very important clue that we need to build cause, as we did here, before we get a move. We do not have cause here. We may have cause on the bigger picture, but we, in a swing trading basis, do not have the case for any kind of a rally phase. And we are just down into support, but nonetheless, something for us to keep an eye on. And with that, I'm sorry for going over. I so appreciate you being here. See you at the Wyckoff market discussions on October 11th, wyckoffanalytics.com to sign up. Free to attend. It's going to be a blast. And again, greatly appreciate you, and we will see you next time.